Good morning, everyone, and thank you for joining us. My name is Jason Cogdell, and I'm a benefits attorney with ProBenefits. We have done, as you likely know, for several years now, a client webinar series, and our goal is to bring you meaningful benefits, compliance, or educational material on a monthly basis, and we typically do 11 of the client webinars each year, and from time to time we'll try a different format, including the mini webinar series that my colleague Chris McCauley introduced in 2015 and has been a success. Today is a first in that instead of the usual presentation style, I'm going to go through a training quiz with the goal of providing some training, refresher, potentially some new information for some of you on the major provision of the ACA that impacts employers, play or pay, otherwise known as the employer shared responsibility provision of the ACA, or the employer mandate. The employer mandate, is a quick refresher, includes two components: play or pay, the requirement that employers that are applicable, large employers that have over 50 full-time employees, offer coverage to all full-time employees or face potential penalties. So that's the play or pay portion. That's what we'll be talking about today. The second piece of the employer mandate is that the ACA reporting, which was due for the first time earlier this year for 2015, and the 2016 reporting is due soon. So today, and I sent the quiz by email late yesterday. Some of you may not have had a chance to look at it. That's fine. If you've taken the quiz and you've already answered it for yourself, great. And you can do that as we go and kind of check your answers, and I'll go through each of them as we go. Before we get to the quiz, and particularly in light of the results of the national elections last week, I want to say a few words about where we stand with the Affordable Care Act in general right now. First of all, some facts. We're 6.5 years into the ACA era. The law was passed and signed into law by President Obama March the 23rd of 2010. So we're 6.5 years into the ACA era, and with one exception, all major provisions of the law that affect employee health coverage, employer requirements, have gone into effect. The only remaining provision is the so-called Cadillac tax, the high cost tax on health benefits, which was originally going to be 2014. Then in the law it was changed to 2018. At the end of last year, it was delayed until 2020. Still remains unpopular, but it's a revenue raiser, and the Affordable Care Act is very expensive for the Treasury, so that is the value and motivation of the Cadillac tax, which as of today is scheduled to apply for 2020. Prior to the election, the two hot topics, and what frankly continue to be the two hot topics of the ACA, are number one, employers dealing with the HHS marketplace notices, which those of you that are employers have probably received one or more notifications that you have an employee or multiple employees at the marketplace receiving subsidized coverage, and how should employers respond to those notices. That's been a hot topic. And then secondly, the new ACA reporting for 2016, which is due beginning in January, and the forms 1095-C are due to be given to employees by the end of January that were full-time for all or part of 2016, and then the 1094-C is due to be provided to the IRS by the end of February or by the end of March if electronic. All of those requirements, by the way, still in place as of today, and I don't expect anything to change between now and those initial deadlines. What I have projected as the key ACA issue for 2017 has been employer mandate compliance, and that with all the things that have been going on the last few years, that employers get back to the basics, that we have to identify whether or not we're an ALE, we have to identify which employees we are required to offer coverage to, and make sure the coverage offered to them is qualifying affordable coverage. So that's what I have projected going into last week as the key issue for 2017. Now, with the result of the election and Donald Trump's election to the presidency, along with the Republicans maintaining control of both houses of Congress, there is much uncertainty. And let me say that much more is unknown than is known right now. A lot of what's being said and written is speculation, including from me, and I've written a blog about what I anticipate to happen in 2017 that you can find on our website and read if you're interested in those thoughts. It's a time of speculation and uncertainty right now. So with that said, I think we're going to see some changes. And frankly, it is my personal opinion that the employer mandate may not survive 2017 and that it may be terminated either soon in 2017, either by Congress or potentially by a non-enforcement order from the White House to the IRS and Treasury, which is part of the executive branch, and certainly the president will have the executive authority to be able to issue some direction in that vein. So do we know for sure that the employer mandate will be in place all of 2017 and that employers that are applicable large employers need to comply? No, we do not know that right now. Similarly, we don't know that employers that complete the reporting for 2016 and turn it in early 2017 truly have to, because ultimately that reporting requirement may be stricken as well. But today, November the 15th, 2016, and going into 2017 and prior to the presidential inauguration, which I believe is January the 20th, nothing's going to change, and we don't know anything for sure about 2017. And what we do know is that the ACA is the law, and that it is, in my opinion, going to take a lot to unwind some of these major parts, not only the marketplace and the individual mandate, but also the employer pieces. So while there is a chance of significant change in 2017, and these requirements may go away for employers, I don't think we can bank on that yet. And I think that what employers need to do is plan to comply with the reporting and with player pay, stay on track, and then if those requirements change or lessened for employers, then make adjustments at that time. I just don't think any preemptive changes right now can be made without, some risk for employers. So those are my observations. Take them with whatever value you find appropriate. So we'll proceed with this session today, and we'll proceed with the compliance work and updates and information that we at ProBenefits provide to you under the assumption that these requirements will stay in place at least in the short term, and then we'll deal with changes as they happen. Regarding player pay, which took effect for the first time in 2015 for employers that had over 100, and then in 2016 applied for the first time for 50 to 99 groups, what I found is this, that despite the fact that it has applied and many employers have been subject to player pay so far, the overall level of education has remained fairly low. I think there are a lot of reasons for that, including the fact that there have been a lot of things to happen in the law in the past few years. In fact, just to use 2016 as an example, employers have spent a significant amount of time dealing with the reporting requirements earlier in the year. And then in the summertime, the DOL released the new overtime rules under the Fair Labor Standards Act, which take effect 12/1. And that's another political discussion to be had, whether or not those stay in place for 2017. But employers dealt with reporting, then the DOL overtime rules, and I think with that, and then all of the other employer responsibilities of payroll, HR, company management, that the mandate has garnered a lot less attention than it did going into 2015. And I think that has contributed to the fact that the overall level of education and understanding among employers and plan advisors has remained low, fairly low. Not 0, but not 10. So now going into this third year, we really don't have any excuses. So let's assume that player pay stays in force in full for at least 2017. The stakes are still high because the potential penalties are there. And right now, as of today and as of the end of this year going into 2017, the IRS is still charged with enforcing the mandate. It's the law, and the IRS is charged with enforcing it. Now, how do they enforce it? They enforce player pay with the reporting. That's why employers do the forms 1095 and 1094 to give the IRS the information about whom was offered coverage, whether or not that coverage was affordable, which employees potentially received no offer of coverage but were full-time, or they received coverage but it was unaffordable and they turned it down. Those are the types of things that reporting answers. So there's a myth out there, well, player pay applies to our organization, but we're not going to be penalized unless we're audited. No audit is needed. We employers, applicable large employers subject to the reporting, voluntarily give the information to the IRS with the reporting forms. All the IRS has to do is review the forms, potentially follow up if they need more information, compare the forms versus other information they have, including information from the marketplace about who may be eligible for a subsidy. So no audit is required, and that is a myth that has been perpetrated that is just not true. Secondly, question from employers, why haven't we seen penalties so far? And the answer is, well, the IRS is getting to it. The reporting that was submitted earlier this year was for 2015. The IRS is reviewing that now. In theory, they'll assess penalties soon for 2015. And then after the 2016 reporting is submitted in early 2017, they'll assess penalties there. So again, my word about best practices, let's know the rules. Let's do what we can as employers to comply and then insulate ourselves from any potential liability. So whether or not the mandate is repealed or modified by the Trump administration in 2017 or Congress, it won't affect us immediately because we'll know we weren't going to be penalized either way, and then we can make adjustments for future plan years. Okay, those are my observations about player pay generally. Now to the quiz. I developed this quiz, and it has several versions. This is the general version that I can give to a group of employers of different sizes. So there's kind of one quiz for small employers, one quiz for large employers, a lot of crossover and similarity there. One basic quiz, and this is kind of basic to moderate, one that would be more advanced. But all of these questions are designed to address the primary mandate issues. Is the employer an ALE? If so, what does the employer need to do? To whom must the coverage be offered? How do you deal with affordability? How do you deal with common ownership? Those basic questions. So some of the 10 questions may not apply directly to your organization as they would if, for instance, I designed a quiz just for your organization based on your size and key requirements. This is more of the general quiz designed to help you gauge where you stand with the mandate, what your level of understanding is, whether you're an employer who's under 50, around 50, or several hundred. This is designed to measure your general aptitude with the mandate. Any questions you have about any of these questions as we go through the answers, be happy to share more information with you, either in response to a specific question or some general reference info. Now, I have, as a training tool, administered this quiz in several different settings over the course of 2016, primarily to employers, sometimes to advisors, sometimes to one employer at a time, sometimes to groups. My original projection is that employers, again, based on my observation that the overall level of knowledge and understanding of the ACA was fairly low, my original projection would be that employers would get about half of them right. And keep in mind, I've administered different versions of the quiz, so that was a very general projection and estimation. And currently, employers have done better than that and are getting about 5.4 right, and some have done very well on the quiz. The pass rate, if you assume passing is 7 or more out of 10, is about 40%. So I'd say on average, people are doing fairly well with the quiz. Advisors are doing probably as well or better than expected on the quiz. But some of these questions are several sentences. There's a true or false in here. We'll just start now. I did email you a copy of the quiz in PDF, so if you'd like to have that in front of you to make notes, you can print that out or pull that up on another screen. I'll just go through them, the questions, and then share the answers and then provide a little bit of explanation. In the interest of time, I'm not going to go through every possible detail of the explanation, so if you'd like any more information and follow-up, just let me know. Question number 1. Got a couple questions here on identifying ALE status. Question number 1. To determine its status as an applicable large employer for 2017, an employer should calculate what? A, the total number of full-time employees as of 1/1/17. B, the total number of full-time employees plus equivalents as of the last day of 2016. C, the full-time employee plus full-time equivalent average for all 12 months of 2016. Or D, the number of full-time eligible as of the 2017 renewal. The answer, C, the full-time employee plus full-time equivalent average for all 12 months of 2016. This is a big key here for employers that are not certain of their status as ALEs for either player pay or reporting, is that we always look back to the prior plan year. Here's a reference slide. So to determine status for 2016, employers should have looked back to 2015 and done a 12-month average. How many full-time employees did you have for each month? How many equivalents? Do that for all 12 months, average the 12-month total, and if it's 50.0 or higher, then you're an ALE for the next plan year. If it's 49.999 or lower, then you're exempt. You're a non-ALE for the next plan year. You're looking at your organization, your single tax ID, EIN, or multiple organizations or EINs if there's a situation of common ownership, such that there may be a control group or an affiliated service group. Going backwards, a common misconception is D, because in many states, the carriers have determined the size of the group and which market segment you're in by the number of full-time eligible as of the renewal. And some carriers are still doing that, even though really they should have switched to a model more consistent with the employer mandate according to the provisions of the ACA. But we're really looking back at the average of the prior 12 months. And so the total number of full-time employees as of 1/1/17, not relevant. The total number of full-time employees as of the last day of 2016, not relevant. I mean, it's relevant, I guess, in the sense that the last month of 2016 would count in the average, but it's really the full-time employee plus full-time equivalent average for all 12 months of 2016. And for those of you that are not certain about that or need help with the math, I'll be happy to share some reference information with you regarding the IRS formula. But the answer is C. Look back to the prior plan year, the 12-month average. You'll see that in the slide packet here, I've got some reference slides pushed in here with the quiz questions, and I'll share a copy of the slides with you so that you'll have that. Question number 2. The employer is not an ALE for 2016. So again, quick background comment. This employer for 2016 looked back at 2015, 12-month average, it was under 50. So for 2016, the employer was not an ALE, exempt from player pay and reporting starting in January 2016. Now, back to the question. The employer added staff in October 2016 and crossed the 50 employee threshold. When must the employer offer coverage, qualifying affordable coverage, to avoid potential penalties? Said differently, when does player pay apply to the employer? It was exempt to start the year, crossed 50 in October. When does player pay apply to this employer? Is it A, immediately, November 1st, 2016? Is it B, 1/1/17, the start of the next plan year? Is it C, 3 months after the 50th employee was hired? Or is it D, the 2017 renewal date if the increase in the fourth quarter triggers ALE status for 2017? What do you think? Here, the answer is D. It's the 2017 renewal date if the increase in the fourth quarter triggers ALE status. And I say that because it's possible that an employer that was under 50 for all of 2016 and then hired a couple of folks in October, November, December 2016, that the 12-month average might stay under 50. If it does, then the employer is exempt again for 2017, and then we'll measure its 2017 data, look ahead for 2018. So that crossing over the 50 threshold in the middle of the year does not have an immediate impact, and it may not even impact the next year if it doesn't affect the overall average. But this is a misconception of employers, and one of the most common questions I receive is, we're in the middle of the plan year, we were under 50, we went over 50, what do we need to do right now? And the answer is nothing, except do the math again for this year to see where you stand for 2017. Here's a slide on ALE determination and more specifics about the calculation of ALE determination. This is something that I would recommend if you're an employer that's either under 50 or anywhere close to 50, that you do this math just to confirm that you know where you stand relative to player pay and that there's no doubt about it. Now, of course, if your company has 10 employees or 200, then you don't need to do the math. You know that you're an ALE or a non-ALE. But for everyone else that's close, I would suggest you take time to do this to make sure you know where you stand. Question 3. Employer is not an ALE for 2016. Okay, again, employer looked at his 2015 data. It was under 50, so it's exempt in 2016, not required to offer coverage. But this employer voluntarily offers coverage in order to provide an employee benefit to its employees. Does that ring any bells? What we used to do before we were required to offer coverage, we offered it because it was a valuable benefit, and we want to attract and retain talented and committed employees who are, by the way, also healthy enough to come to work. With which of the following ACA rules must the employer comply? So the employer is not required to offer coverage because it's not an ALE, but it offers coverage anyway. With which of the following ACA rules must the employer comply? Or, another quick comment here, if you are an ALE, if your organization has more than 50, look at this question this way. For people that you employ that are not full-time, what rules do you have to qualify? If you seek to offer people coverage who are either part-time employees or independent contractors or temporary employees that you're not even required to offer coverage to, what rules do you have to comply with? The same answers would apply. Does the employer have to comply, A, with the 30 hours per week rule under the ACA, B, the affordability rule, 9.66%, C, the minimum value rule, bronze major medical coverage requirement, or D, none of the above? This employer who's not subject to the mandate in 2016 for all or some of its employees has to follow D, none of the above. And the reason for that is that each of these rules is part of the employer mandate. If you're not subject to the employer mandate, the 30-hour rule does not apply. Now, the carriers often require 30 hours rule in their contracts, but the ACA does not require 30 hours a week for every employer, only for applicable large employers subject to the mandate. Same thing with affordability. An employer that's not subject to the mandate can charge whatever it wants to employees. The affordability rule is not a concern. Also, the minimum value standard is not a concern. An employer could choose to offer the so-called skinny plan or minimum essential coverage plan to employees if it's not subject to the mandates. All those rules are part of the mandate. So just to add a footnote there, if your organization does offer, if you are an ALE and you offer coverage to part-time employees or any other non-full-time employees, independent contractors, board members, etc., just know that those considerations do not apply. 30 hours, affordability, minimum value, you don't have to comply with those rules under the law. Okay, there's a quick slide on ALE status. Question 4. Now, let's focus on ALEs for the remainder of the questions. Employer is an ALE for 2016 and subject to play or pay, but this employer elects not to offer coverage to its employees. What is the anticipated penalty? So this is an employer that is subject to the mandate, and regardless of how many employees it has, it decides not to offer health coverage. So maybe it offers health coverage to no one, or maybe the employer has 100 employees and it chooses to only offer coverage to 10 members of management. But in any event, coverage is not offered to everyone, and so the 4980HA penalty, otherwise known as the A penalty or the sledgehammer, is going to apply to this employer, or it more specifically is the worst case scenario for this employer. What will the projected anticipated penalty be for the employer? Will it be A, an automatic 2160 times all full-time employees that were not offered coverage? Is it B, if one or more of the full-time employees that were not offered coverage receive subsidized coverage from the marketplace, then the penalty will be the number of full-time employees per month minus 30 times $180, which is 1/12 of 2160. 2160, by the way, is the indexed penalty amount under player pay. C, no penalty if IRS does not audit. We've already debunked that one. Or D, will it be $100 per day, which is the ACA's general compliance penalty? A and B both look like they could be right. The one that's right is B. First of all, if this employer does not offer coverage in 2016 and none of the employees go get a marketplace subsidy, there will be no penalty because the marketplace subsidy is what triggers the penalty for any employer. If at least one of the employees who's full-time and not offered coverage gets a marketplace subsidy and that triggers the penalty, then what the sledgehammer penalty would be calculated based on the IRS Form 1094-C that the employer completes for the IRS and turns in early 2017. The number of full-time employees per month, that's one of the columns on the 1094-C, minus 30, because every employer gets a break of 30 employees, times the monthly penalty, which is 1/12 of $2160 or $180. So that is the penalty. The penalty is calculated monthly by the IRS, not an automatic annual penalty. And there's tremendous confusion by employers about what potential penalties are. Again, if an employer is an ALE, as an example, the employer has more than 50 full-time employees plus equivalents, but really just a small number of full-time employees. And I see this a lot with restaurants and other service-type organizations. Then the maximum penalty is the number of full-time employees minus 30. So if you have less than 30 full-time employees, then the maximum penalty is 0. Versus the employer that has 500 full-time employees, well, the maximum penalty would be 500 minus 30 times the penalty, which would be astronomical. So this is the way, and I think every employer, whether you're offering coverage or not, should know the worst case scenarios of your strategy, whether that's the sledgehammer or it's the tack hammer, which we'll talk about. But this is an example of the sledgehammer penalty for an employer that does not offer coverage. Question 5. Forgive all the text on the screen here. Employer is an ALE. In determining whom it must offer coverage to, all 30-plus hour full-time employees, which of the following categories of employees is not required to be identified and offered coverage? So of these 4 answers, 3 groups need to be offered coverage, 1 does not. Which does not need to be offered coverage? Is it A, full-time employees who have completed an eligibility waiting period? B, variable hour employees who have completed an initial or ongoing measurement period. They've averaged 30 hours, but we're not expecting them to work through the next plan year. C, a newly hired variable hour employee who is in the middle of an initial measurement period and through 6 months has averaged 30 hours. Do we have to offer that person coverage now? Or D, an employee who was originally hired as seasonal and has worked a full-time schedule for more than 6 consecutive months. 3 of these groups we have to offer coverage to right now. 1 we do not. Which do we not? Answer C. If we've hired a new hire, classified them as a variable hour because we cannot determine at hire whether or not they will average 30 hours. So we start measuring from the date of hire for 12 months before we determine eligibility. And if 6 months into that measurement period, the employee's averaging more than 30 hours, but we're in the middle of the measurement period, do we have to offer them coverage? No, we can finish the initial measurement period. And then if the employee works the 30 hours a week for the measurement period, which would be 1,560 hours, then we'll offer that employee after 12 months. By the 13th month, we'll offer coverage to that employee. For these other 3 categories, full-time employees who've gone through the waiting period, employees classified as variable who have gone through the measurement period and qualified have to be offered coverage. And seasonal, the seasonal exception is someone who's hired as seasonal and works less than 6 consecutive months. If someone is hired, seasonal or not, and they work full-time hours for more than 3 months, unless they're variable, they need to be offered coverage. So if we hire someone seasonal, they work 40 hours a week, and they're still here after 6 months, that person's full-time. They need to be offered coverage because they did not qualify for the seasonal definition. And of course, eligibility is a topic with many other possibilities and situations and facts that I can't cover in this context, but I wanted to use that question to address that topic, which I think continues to be a challenging topic for employers. And one of the big responsibilities under player pay is make sure we're handling eligibility correctly. That's one of the main topics in my training sessions right now. Question number 6, less text. True or false? These are fan favorites. Employer is an ALE. Every employee who qualifies for health coverage and enrolls, whether that person was hired full-time and got coverage after the waiting period or whether that person qualified by measurement period, true or false, every employee is in a stability period and is guaranteed eligibility for a certain length of time of up to 12 months. True or false? The answer, true. Another misconception of employers is regarding the stability period. The way the ACA is written, and no surprise, very employee-friendly and not as employer-friendly, is that every employee is in a stability period. So whether we automatically give someone coverage because they were hired as full-time, satisfied a waiting period of 0 to 3 months, or whether this is someone who was classified as variable, we measured, and they qualified as full-time. Either way, that person is in a stability period. The default is that the stability period is the plan year, 12 months, so that even if someone goes to part-time status in the plan year, they're probably still eligible. And there are some exceptions to that rule, but whereas in the old days, meaning pre-player pay, if someone went from full-time to part-time, we would terminate them from the coverage, offer them COBRA. We cannot automatically do that now. We have to look at every employee on a case-by-case basis and see, okay, this person's status has changed. How much longer are they eligible? And in most cases, the person is eligible through the remainder of the stability period, which hopefully tracks with your plan year. But every employer needs to know that every employee is in a stability period. The question is just how long is that stability period? The shortest stability period is 3 months. The longest is 12 months. And I won't go into detail on that now, but we need to know that a stability period applies to every employee once we've determined them eligible, once they have enrolled. Question 7, affordability. This is a common scenario that will affect nearly every applicable large employer, whether or not you think you have an affordability concern. This question is relevant to you. Employer is an ALE. Employer's health insurance for employee-only coverage has a total premium of $500 per month for the current plan year. So total premium paid by the employer to the carrier, $500 a month. Employee X is a $10 per hour full-time employee projected to earn $20,000 for the year. The employer's strategy is to offer coverage 50% paid by the employer, 50% paid by the employee with pre-tax payroll deductions. So the employee share, if the employee enrolls, is $250 paid pre-tax through the Section 125 plan of the employer. This employee X enrolls. Does employer have an affordability issue for employee X who has enrolled in the plan? Yes or no? The answer, no. Even though $250 might be more than 9.66% of employee's income, employee enrolled. And every employer needs to know this and hear this clearly. We do not have an affordability issue for any employee who enrolls. The only affordability issue is for those that decline, because the employer's only exposure is if the employee declines coverage that's unaffordable, goes to the marketplace, gets a subsidy, which would trigger the B penalty, the tack hammer on the employer. If the employee enrolls, whether the coverage was cost of $0 for the employee or $250, the coverage is automatically affordable. And on the 1095C, anytime that we can put on line 16 of the 1095C the code 2C, 2C, that stands for enrolled. That's the Trump code, no pun intended. That means employer enrolled, employee enrolled, employer did everything it was supposed to, coverage is automatically affordable, IRS move on to the next employee. Now, what about the opposite scenario? What about if the employee had declined? Does the employer have an affordability issue? It appears so, because whether you use any of the safe harbors, $250 is more than 9.66%. So if that employee declined coverage and went to the marketplace, it could potentially trigger penalty on the employer. So this employer will want to reassess affordability and either identify its risk under the B penalty or make that coverage less expensive, either for everyone or at least for the employees that are on the low end of the pay wage scale. And yes, employers can pay more for lower paid employees than they do for higher paid employees. It's basically reverse discrimination, or to quote a advisor and friend, compassionate contributions. The employer can do that. So that's affordability right there. If the employer one question submitted, what would the penalty be if the employee declines the coverage for $250, gets a marketplace subsidy, and keeps it for 1 or more months that the employer is an ALE, then that penalty would be, the monthly penalty, the B penalty would be $270 a month, verified by the reporting, only for the months that the employee had the subsidy and kept it. So the employee would, if the employee keeps the subsidized coverage at the marketplace, the employer is penalized $270 a month. And so some employers may say, well, that's no big deal. I mean, we would have paid $250 at the enroll. We're just paying $270. We're willing to take that chance so that fewer employees will enroll in our coverage at $250. That's fine. The only difference being if the employer pays $250 a month for the health plan, then that is fully deductible by the employer, but the penalty would be non-deductible. Question 8, staying with affordability. And this is just a general question. The same employer from the prior question seeks to meet the affordability standards. So he wants to tweak its $250 contribution rate so that all employees have access to affordable coverage and no penalties are applicable. So this employer wants to insulate itself from the B penalty. This employer, again, $500 a month total premium for employee coverage, and that's the lowest cost. So this employer may have a dual option, but what matters is the lowest cost qualifying coverage. In this case, this is the lowest cost plan. What are the employer's options if it's not going to charge $250? Does the employer have to charge lower than and I use 9.69% here because that's the percentage number for 2017. It was 9.66 for 2016. Does the employer have to charge less than 9.69% of the federal poverty level, $94 a month or less, to make it affordable? B, should the employer charge less than 9.69 of the lowest W-2 income of full-time employees from the prior calendar year? Is that its only option for affordability? C, employer has multiple options, including 3 safe harbors for affordability. D, employer must be prepared to adjust the end-of-year wages for any employees for whom the cost of coverage exceeds 9.69% of income. There is some value to all 4, but the right answer is C. This employer has multiple options. This employer could choose to follow one of the 3 safe harbors: federal poverty limit, rate of pay, or W-2. This employer could choose to go ahead and charge the $250 and know that that would be affordable to some earners, but then those earners for whom $250 would be unaffordable, the employer would offer to pay more of that coverage. That would be called tiered contributions, or again, reverse discrimination. That's an option for the employer. The employer could choose to set a rate where it charges every employee a percentage based on income. There are multiple options for this employer. The best options would be to meet one of the safe harbors. The most conservative safe harbor is the federal poverty limit. If the employer charges less than $94 a month, it will automatically be affordable to everyone. But not many employers do that. Probably a third. Most other employers either look to the rate of pay, which is based off the $10 per hour number, if that's the lowest number for the employees, or the W-2 number. But the employer is not required to follow any of those specific options. Now, one other question on affordability and the B penalty or tack hammer. Employer is an ALE and offers qualifying affordable coverage to all 30-plus hour employees. So this is the ideal scenario. The employer wants to take the penalties off the table. So let's offer coverage to all of our full-time people, and let's make it affordable through whatever method. So the employer did that. And let's just assume this employer, for this example, has 100 employees, 100 full-time employees. It offered coverage to all. 30 of the 100 declined. So 70 enroll, 30 decline. 5 of the 30 who decline go and get coverage through the health insurance marketplace, either for themselves or themselves and family. Question: will the employer be assessed a B penalty or tack hammer because of the 30 who waived or the 5 who went to the marketplace? Will the employer be assessed a B penalty? Is it A, yes, if any of the 5 receive a premium subsidy. B, yes, if enrollment in the employer's plan is less than 75%. C, no, because of the -30 rule. Or D, no, assuming that the employer's Form 1094, 1095 reporting verifies that they've offered coverage to everyone and that the coverage was affordable. Hopefully you're there. D is the answer. No, this employer will not be penalized. If you offer, and this is how the reporting helps us. It allows us to verify to the IRS that we did what we were supposed to do. If we've got 100 employees, we offer them all qualifying major medical coverage, and it's affordable to all based on one of the 3 available safe harbors or an alternative method, but it's affordable to everyone. Then even if 30 decline, and even if 5 of them go to the health insurance marketplace, those 5 are not eligible for a subsidy. And if HHS gives them the subsidy, and this is happening in 2016, if HHS gives them the subsidy, that's HHS's problem, because we're going to document on the 1095-C and then the 1094-C that we provide to the IRS with copies of the 1095-Cs for 2016. We're going to verify that we offered coverage to all these people and that it was affordable. And so if HHS in the marketplace reports to the IRS John Smith's tax ID number, John Smith got a subsidy, John Smith is an employee of Acme Inc. Well, Acme Inc. has said we offered John Smith coverage, it was affordable. And then if the IRS comes to us for more information, we're going to prove we offered it to them, it was affordable. We are not going to be penalized. And just so you know, and to add some comfort for you employers that are concerned about player pay risk, what the law says is that the IRS cannot assess a penalty on an employer until the employer has been assessed and had an opportunity, or has been alerted and had an opportunity to defend and explain the penalty. And some of you are saying, well, good grief, we're in the midst of this marketplace notice deal, and we've appealed some, and some have been denied, and HHS has been ridiculous about what they're approving or denying. I agree, and I have no idea why they're being so restrictive. And really, they've created a problem for themselves by not taking the subsidy away from some of these folks that have been ineligible. But the good news is that's their problem. What we care about is the IRS and player pay, and we're going to be able to defend it and show that we offered affordable coverage. And so I know the Form 1094, 1095 reporting is a pain, and I know some of you would like to avoid it, and that may be a positive benefit of what may happen in 2017 for you, but just know that it is a pain, but it's also helping us, because it's helping us verify that we did what we were supposed to do and we're not, or should not be, penalized. So that's just a quick word about how that B penalty works and how the reporting syncs with that. Finally, question 10. The employer is one of 3 related commonly owned entities, and I know that many of you are in this situation, that you have one or more entities that are affiliated by common ownership or common operations with your organization. Each of these 3 entities has about 20 full-time employees. They're in different industries, but they're related by common ownership. So because of the IRS control group rules that apply in this context, each of these 3 entities is an ALE. So even though they have 20 on their own, combined they have 60, or did in the prior year, they're all ALEs. 2 of the 3, entities 1 and 2, offer qualifying affordable coverage to all 30-plus hour employees that they employ to avoid any penalties. But entity 3, whether because of its industry or whatever, does not. So entity 3 has 20 full-time employees, but it didn't offer coverage to any of them. If penalties are triggered, and this would be the A penalty or the sledgehammer, which, if any, entities will be penalized? Will it be all 3 entities? B, none of the 3 entities, since fewer than 30 employees were not offered coverage? Will it be C, the largest entity or the parent entity? Or will it be D, entity number 3 only? The answer, D, entity 3 only. Player pay is administered and enforced on a tax ID by tax ID basis. So just because you have multiple tax IDs and that causes you cause each other to be ALEs, the compliance reporting and player pay still is on a tax ID by tax ID basis. So if entity 1 and entity 2 offer coverage to all employees that's affordable, then regardless of whether those employees enroll or not, no penalties. But entity 3 is potentially exposed. So if entity 3 does not offer coverage to the 20 full-time employees, and if any one of those 20 gets a marketplace subsidy, that will trigger the sledgehammer. Now, next you say, well, what I'm going back to the prior slide. What about B? Because wouldn't they get a minus 30? No. In the control group rule, the minus 30 is split among the control group entities. So in this case, just assuming they're all equal, each entity would get a minus 10. So entity 3's maximum penalty would be 20 full-time employees minus 10 times the penalty. So entity 3 would be penalized in that scenario, even though entity 1 and entity 2 would not be. So the minus 30 is divided pro rata among the entities. And I don't expect you to know that. And from that standpoint, this has turned out to be this year more of a trick question than not intended. That's what somebody's already referred to it as. It's not intended to be a trick question. It's just meant to suggest that player pay is enforced on a tax ID by tax ID basis, and each tax ID has to comply or be penalized, but that will not go across the line to the other tax IDs. A question regarding this, regarding the commonly owned entities, can one of the two entities include the other two entities' employees on their policy instead of having separate policies? Absolutely. So none of the player pay rules require the employer to have its own plan. The employer could offer coverage along with a related entity. And so you could have one plan for all three, or 3 plans for all 3, or 2 plans for 3. No problem there. So the rules about whether employers can combine is still largely a carrier-driven rule for fully insured plans, and it's a state law and federal law issue for self-funded plans. But none of the rules prevent employers from joining forces to offer plans. Those are the 10 questions. How did you do? I'd be interested if any of you took the quiz in advance, or if you made an answer before I shared the answer and you're willing to share the number that you got right. Please share that. You can share that through the question box or respond by email. I'd be interested to hear how many you got right, how many you got wrong, if you have any questions, or which of the ones you found to be difficult. I'm going to cover a couple of quick questions here and then wrap it up. A couple of quick questions to answer that have been submitted during the quiz. First, when calculating the total employee headcount, are owners included and owners' children included in the headcount? So that would go back to the question of counting employees for ALE purposes. And the answer is generally no. An employee is a common law employee. So if you have an owner who's not an employee, then we don't have to count that person. So if we got an S corporation owner, LLC member, partner in a partnership, we don't have to count those individuals. And they're also, by the way, not required to be offered coverage. They wouldn't count in the employee headcount or the penalty headcount. A C corp, the owners are considered to be common law employees, so we would have to count them. But anyone else, if you have owners' children who are bona fide employees, true common law employees, we would count them. But if they're not, if they're only, if they're related to the owner but they're not actually employees, we wouldn't have to count them. We wouldn't have to count independent contractors or directors or anyone else who does not qualify as a common law employee. And by the way, your owners, like an S corp owner, even if the S corp owner receives W-2 income, they're still an owner, not an employee. So whether or not someone gets W-2 income is relevant to whether they're an employee, but that's not the sole determining factor. Yeah, good stuff on the, it looks like some of you did very well on the quiz. I've seen a few 80% numbers and all, and that's great. I'm excited about that. I'm not surprised. Some of you are ahead of the game, and so I think a lot of it's fine-tuning for you. And those of you who feel like, wow, there's a lot I don't know and I need to revisit, this is designed to help you know that, so that you've got this month in December and going into 2017 to revisit the key issues, and then virtually do a risk analysis of where you stand versus what you may need to do. Thanks for the comments. I'm enjoying reading those. A couple other questions here. I think in the interest of time, what I'm going to do is go ahead and wrap it up now. I did include in the slides, by the way, I'm going to share the slides with all of you, and we'll try to share those here in the next couple of days along with a link to the recording. Here's a quick slide on ACA reporting and just a summary of the deadlines. We're also in the process of finalizing for release our 2017 one-pagers on reporting and our compliance checklist, which we'll present at the December webinar, which I think will be on Thursday, December the 15th. So if you need one of our one-pagers on benefits compliance or reporting or player pay, let me or Chris know, and we'll be happy to share that with you. We will have some type of reporting training going on in December and January, assuming everything stays in place. I know a couple of you have issued some questions in the question box. If you have a few minutes, I'll try to get to those in the next couple of minutes. Otherwise, if I don't answer your question, feel free to email it to me, and I'll try to get back to you as soon as I can. As always, thanks for your time and joining our webinars. I hope this was helpful to you. I know it's a little bit tedious since we don't have any back and forth as we would in a live workshop dealing with the quiz. If you're interested in more specific training on the mandate or reporting, either for your organization or for your group or some type of association that you're involved in, that is something that I do as part of our compliance services with ProBenefits. And if we can help you with any matter related to plan administration or ERISA compliance or ACA, be happy to contact us and contact us, and we'll be happy to help you. Thanks for your time today. Those that have issued a question, hang with me for a few minutes, and I'll try to get to those in the question box. To everyone else, have a great day, and thanks for joining us.